You crossed $250,000 in W-2 income. And the moment that happened, Wall Street stopped seeing you as a client. They started seeing you as an exit. Not a sophisticated investor. Not a valued relationship. An exit. A liquidity event for institutional paper they cannot move anywhere else. Right now, across every major wirehouse in this country. Merrill Lynch. Morgan Stanley. UBS. Wells Fargo Advisors. There is a structured, deliberate pipeline designed to offload illiquid, fee-laden, underperforming private credit instruments onto one very specific demographic, the mass affluent, the $250,000 to $750,000 W-2 earner who just cleared the accredited investor threshold and is hungry enough to feel exclusive, but not wealthy enough to have independent institutional counsel verify what they're actually buying. That threshold is not a status marker. It is a targeting mechanism. Here is the math that your wirehouse financial advisor will never walk you through in that glass-walled conference room. A large private equity firm raises a $2 billion credit fund. The institutional capital, pension funds, sovereign wealth funds, university endowments, gets allocated to the fund's senior tranches. Lowest risk. First priority on repayment. Preferred return structures. The family offices and ultra-high net worth investors with independent due diligence teams often negotiate co-investment rights or simply pass entirely after reviewing the fund's audited performance attribution. What remains? The subordinated debt tranches. The illiquid middle market loans, with 7 to 10-year lockup periods. The instruments carrying embedded fees of 1.5% to 2% annually in management fees, plus a 20% carried interest on any upside. The paper that survives a credit stress event. Last, that paper needs a home. And that home is your brokerage account. Your wirehouse advisor packages it as an exclusive private credit opportunity unavailable to retail investors. That framing is technically accurate and strategically misleading at the same time. Yes, it's exclusive. It's exclusive because the investors with the institutional firepower to actually scrutinize it already declined. The behavioral architecture behind this is surgical. A 38-year-old senior director earning $310,000 annually in W-2 compensation does not think of themselves as a retail investor. They've worked 12 to 14-hour days. They've outcompeted their peer group. The private equity fund pitch deck, delivered over a catered lunch with a wirehouse advisor in a mahogany-finished office, does not feel like a sales transaction. It feels like a rival. It feels like finally being on the same side of the table as the institutions. That psychological moment, that validation hit, is precisely what the distribution model is engineered to exploit. McKinsey's 2024 Global Private Markets Review estimated that retail and mass affluent investor allocations to private credit grew by over 43% between 2022 and 2024. The primary driver wasn't performance. It was distribution. Wirehouses dramatically expanded their alternative investment shelf space, capturing 12-month trailing revenue increases that in some divisions exceeded $4.2 billion industry-wide in fee income alone. The product wasn't getting better. The sales infrastructure was getting deeper. Here is what the institutional world calls this dynamic. The proprietary term used internally at the fund level is retail distribution arbitrage. When an institution cannot find qualified institutional buyers at the target price point, they restructure the minimum investment thresholds, often dropping from $5 million down to $25,000 or $50,000, and route the paper through wirehouse advisor networks into mass affluent portfolios. The advisor earns a placement fee, often ranging from 1% to 3% of invested capital upfront. That fee is not prominently disclosed on the first page of the pitch deck. It's buried in the fund's prospectus, on page 47. Call this what it is. The institutional dump cycle. Institutional sellers engineer scarcity framing. Wirehouses provide the distribution infrastructure. Mass affluent investors provide the exit liquidity. And the fee extraction happens at every layer of that chain, before the investment has produced a single dollar of return for you. The compounding damage is not just the underperformance. It is the illiquidity trap. A $100,000 allocation into a 7-year lockup private credit fund at age 38 years old is not a $100,000 decision. It is a decision about where $100,000 of your capital is completely immobilized during what are statistically your highest earning, highest compounding accumulation years. If that same $100,000 had been allocated into a low-cost, diversified index position, generating an annualized 9.5% return over that same 7-year horizon, the terminal value would be approximately $191,000 before tax considerations. The private credit fund, after subtracting 1.75% annual management fees and 20% carried interest on a projected 10% gross return, delivers a net return closer to 6.8% annually to the limited partner. Terminal value on $100,000 over 7 years at 6.8%, approximately $158,000. The delta between those two outcomes is approximately $33,000 on a single $100,000 allocation. Multiply that across a $500,000 alternatives portfolio, which is not uncommon for a $300,000 to $400,000 W-2 earner who has been systematically guided toward this shelf, and the cost of the institutional dump cycle exceeds $165,000 in foregone terminal wealth. That is not a fee. That is a structural wealth transfer. The institutional grade correction here is not complex, but it requires a complete psychological reframe of what exclusive access actually means. Before allocating a single dollar to any private credit, private equity, or alternative investment product offered through a wirehouse relationship, you must independently answer one question. Who tried to buy this before me? And why did they pass? Request the fund's distribution history and minimum investment evolution over time. Hire a fee-only, fiduciary registered investment advisor, not affiliated with any wirehouse or placement agent, to independently review the fund's audited financials, waterfall structure, and historical loss rates in the subordinated tranches. The cost of that independent review, typically $2,500 to $5,000, is the single highest ROI financial decision you can make before committing 6 figures to a 7-year illiquid position. Access is not the signal of opportunity. The absence of institutional buyers who had full access is the signal of risk. If a sovereign wealth fund with a $40 billion balance sheet passed on this tranche, the burden of proof for why you should buy it at $50,000 is not on them. It's on your advisor. And this wealth extraction mechanism does not operate in isolation. The same mass affluent demographic that is absorbing institutional junk paper through wirehouse channels is simultaneously carrying a legal and liability exposure that most $300,000 to $500,000 earners are completely blind to, because the same illiquid, opaque asset structures being sold to them offer zero protection. When a single lawsuit strips the underlying net worth clean, the moment your wirehouse advisor routes your wealth into a liquid, poorly structured private placements, your ability to rapidly liquidate and shield assets in a legal crisis collapses entirely. Click the video on your screen right now, and let's dissect exactly how the $3 million liability cliff systematically destroys the wealth of top earners who never saw the lawsuit coming.